ExamPrep.School. Vermont Producers Casualty Insurance Exam, exam code SERIES 14-42. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Auto insurance, business owner's policy, casualty insurance basics, commercial package policy, general insurance, homeowner's policy, insurance regulation, other coverages and options, workers' compensation insurance. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which of the following transactions is a Vermont insurance producer with only a personal lines license authorized to conduct? A. Commercial general liability insurance. B. Private passenger automobile liability insurance. C. Variable annuity contracts. D. Title insurance. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The personal lines license in Vermont covers private passenger auto and residential property lines, but excludes commercial, variable, and title products. Reason A is not correct. Commercial general liability is outside the scope of personal lines and requires a broader casualty or commercial license. Reason C is not correct. Variable annuity contracts are securities related and require a separate variable products license. Reason D is not correct. Title insurance is a limited line requiring a specific title insurance license. Question 2. Under Vermont law, a non-resident insurance producer may transact insurance without obtaining a Vermont non-resident license for up to how many days in a calendar year? A. 90 days. B. 30 days. C. 60 days. D. 15 days. The correct answer is D. Vermont statutes permit non-resident producers to engage in insurance transactions for up to 15 days per calendar year before a non-resident license is required. Reason A is not correct. 90 days greatly exceeds the allowed duration for unlicensed non-resident transactions. Reason B is not correct. A 30-day period exceeds the statutory limit, which is strictly 15 days without a license. Reason C is not correct. 60 days is not authorized under Vermont reciprocity rules. The limit is 15 days. Question 3. Prior to taking the casualty line licensing examination in Vermont, an applicant must complete how many hours of pre-licensing education? A. 30 hours. B. 12 hours. C. 24 hours. D. 20 hours. The correct answer is D. Vermont requires 20 hours of classroom pre-licensing education, specifically for the casualty line, before an applicant may sit for the exam. Reason A is not correct. 30 hours exceeds Vermont's casualty line pre-licensing requirement of 20 hours. Reason B is not correct. 12 hours is the requirement for a personal lines license, not casualty. Reason C is not correct. 24 hours is not a Vermont standard. Casualty requires 20 hours. Question 4. Based on the fee schedule in 8 VSA Section 4800, what is the total application fee the applicant must pay? A. $175. B. $200. C. $215. D. $235. The correct answer is C. The correct answer is $215 because 8 VSA Section 4800 establishes a $100 non-resident license application fee, a $25 fee per line of authority, 3 lines multiplied by $25 equals $75, and a $20 fee per producer appointment. 2 appointments multiplied by $20 equals $40. The sum of these fees is $215. Reason A is not correct. This calculation omits the appointment fees required for each insurer. Reason B is not correct. This misapplies an appointment fee as an additional line of authority fee. Reason D is not correct. This assumes an incorrect $30 appointment fee instead of the statutory $20. Question 5. Under Vermont statute, Section 4724, subsection 1, which statement most accurately describes the prohibited conduct defined as boycott, coercion, or intimidation in insurance business practices? A. Any agreement or act by which insurers or producers use pressure or threats to restrict another insurer's sale of insurance. B. Coordinated refusal by insurers to underwrite certain risks to pressure producers. C. Use of misleading sales tactics to coerce policyholders into purchasing additional coverages. D. Collusive arrangements among insurers to fix rates or policy forms. The correct answer is A. The correct answer is the agreement or act using pressure or threats to restrict another insurer's sale of insurance, which matches the statute's definition of acts intended to coerce or intimidate to obstruct the free flow of insurance business. Reason B is not correct. Refusal to underwrite certain risks for pressure relates to selective underwriting, not the broader coercion or intimidation definition. Reason C is not correct. Misleading sales tactics to upsell policyholders is a misrepresentation issue, not the statutory coercion or boycott provision. Reason D is not correct. Rate fixing is an antitrust-like practice but does not specifically address coercion or intimidation under Section 4724, subsection 1. Question 6. Under Vermont regulations prohibiting false advertising of policy terms, which action would violate the false advertising prohibition? A. Describing a renter's policy as covering flood damage without disclosing the flood exclusion. B. Offering discounted premiums for policies issued through an insurer's online portal. C. Using a generic umbrella icon in marketing materials without mentioning umbrella insurance. D. Highlighting that policy rates are approved by the commissioner in a rate schedule. The correct answer is A. The correct answer is misrepresenting coverage by stating flood damage is covered while omitting the exclusion, which constitutes false or misleading statements about policy terms under the prohibition. Reason B is not correct. Offering discounted premiums for digital issuance is a permissible marketing incentive, not a false statement of policy terms. Reason C is not correct. Using an icon without specifying coverage does not misstate the policy's actual terms or exclusions. Reason D is not correct. Stating that rates are commissioner approved is factually accurate and not misleading. Question 7. An insurance producer in Vermont advises a homeowner to cancel her dwelling fire policy with Northern Vermont Mutual and replace it with an identical policy at another insurer. 9 months later, the producer again recommends canceling that replacement policy and purchasing a third equivalent policy solely to earn additional commissions. Under Vermont unfair trade practices regulations, this conduct is an example of what offense? A. Twisting. B. Churning. C. Rebating. D. Coercion. The correct answer is B. This conduct exemplifies churning, which is the repeated replacement of a policy primarily to generate additional commissions without providing any new benefit to the insured. Reason A is not correct. This choice is incorrect because twisting involves inducing a policy replacement through misrepresentation of its benefits or terms, which is not described here. Reason C is not correct. This choice is incorrect because rebating refers to offering unapproved inducements or returning part of the premium to influence a purchase, which does not apply. Reason D is not correct. This choice is incorrect because coercion involves forcing or threatening an insured, whereas the scenario describes voluntary but repeated replacement for commission. Question 8. Under Vermont's Market Conduct Examination Authority, within how many days must an examiner submit the written report to the commissioner after completing the examination? A. 30 days. B. 120 days. C. 90 days. D. 60 days. The correct answer is D. The correct answer is 60 days because Vermont statute requires examiners to file their market conduct examination report with the commissioner within 60 days of completion. Reason A is not correct. 30 days is too short. The statute specifies a longer filing period. Reason B is not correct. 120 days greatly exceeds the period allowed for report submission. Reason C is not correct. 90 days exceeds the maximum time frame established by the statute. Question 9. According to Vermont regulation, how often must the commissioner conduct a full financial examination of a domestic insurer? A. Every 12 months. B. Every 24 months. C. Every 36 months. D. Every 60 months. The correct answer is D. The correct answer is every 60 months, because Vermont law mandates a full financial examination of each domestic insurer at least once every 5 years. Reason A is not correct. Annual examinations are not required for every domestic insurer in Vermont. Reason B is not correct. Biennial examinations are more frequent than the statutory requirement. Reason C is not correct. Triennial examinations exceed the mandated interval. Question 10. A Vermont insurance producer is found to have misrepresented policy coverages to 3 clients in separate transactions over the past 2 weeks, resulting in consumer harm. This is the producer's first disciplinary matter, and they have cooperated fully with the commissioner's inquiry. Under Vermont law, what disciplinary action should the commissioner most appropriately take? A. Suspend the producer's license for a period not to exceed 90 days. B. Revoke the producer's license permanently. C. Impose a civil monetary penalty without suspending the license. D. Place the producer's license on probation for 1 year. The correct answer is A. Vermont statutes authorize up to a 90-day suspension for a first offense of misrepresentation, whereas revocation is reserved for serious or repeated violations, and fines alone do not address immediate consumer protection. Reason B is not correct. A permanent revocation is reserved for serious or repeated violations and would be unduly harsh for a first offense with cooperation. Reason C is not correct. A fine alone fails to remove the producer from practice and does not directly remedy the immediate consumer protection concern. Reason D is not correct. License probation does not temporarily remove authority to transact business and is not the statutory remedy for misrepresentation. Question 11. Which of the following best describes the primary distinction between a stock insurer and a mutual insurer in terms of ownership rights? A. Mutual insurers are prohibited from purchasing reinsurance, unlike stock insurers. B. Only stock insurers may allocate portions of their underwriting surplus to policyholders. C. Policyholders are the owners of a mutual insurer, whereas shareholders own a stock insurer. D. Stock insurers operate on a cooperative basis, granting 1 vote per policyholder. The correct answer is C. The correct answer identifies that in a mutual insurer, ownership rests with the policyholders, whereas in a stock insurer, ownership rests with shareholders. Reason A is not correct. That choice incorrectly asserts that mutual insurers cannot purchase reinsurance, but both stock and mutual insurers commonly use reinsurance. Reason B is not correct. That choice wrongly attributes the ability to allocate surplus to policyholders exclusively to stock insurers, whereas this is a feature of mutual insurers. Reason D is not correct. That choice describes stock insurers as cooperative entities granting votes per policyholder, which reverses the actual ownership voting structure. Question 12. According to the Liability Risk Retention Act of 1986, what requirement must be met for an organization to qualify as a risk retention group? A. It must obtain separate licenses in every state where it insures risks. B. It must rely on state guarantee funds to cover policyholder claims. C. Its members must have similar or homogeneous liability exposure profiles. D. It may only offer life insurance coverage to its members. The correct answer is C. Under the Liability Risk Retention Act of 1986, a risk retention group must be composed of members sharing similar liability exposures to qualify for federal chartering. Reason A is not correct. That choice incorrectly states that multi-state licensing is required, whereas federal law permits operation under a single chartering state license. Reason B is not correct. That choice wrongly suggests dependency on state guarantee funds, but risk retention groups are exempt from those funds. Reason D is not correct. That choice incorrectly limits coverage to life insurance, whereas risk retention groups focus on liability insurance for members. Question 13. A producer is seeking coverage at Lloyd's for a client's high-risk chemical manufacturing operation after standard carriers declined. Which characteristic of Lloyd's associations explains how a single policy's risk is distributed among underwriters? A. A single syndicate underwrites the entire policy and then purchases reinsurance for excess exposures. B. Multiple members of different syndicates subscribe to set percentages of the same risk on a single policy. C. The managing agent consolidates premiums into a mutual fund and allocates losses equally across all members. D. Corporate capital providers underwrite the policy and then cede portions to external reinsurers. The correct answer is B. This option correctly describes Lloyd's subscription system, in which multiple members each accept predefined shares of a risk on the same policy, distributing exposure among underwriters. Reason A is not correct. It describes a single syndicate relying on reinsurance rather than the subscription market where many underwriters each take a portion of the risk. Reason C is not correct. It implies a pooled mutual fund and equal loss allocation, which does not reflect individual members subscribing to specific percentages. Reason D is not correct. It refers to ceding portions to external reinsurers instead of members directly subscribing to set shares of the risk. Question 14. Which of the following most accurately distinguishes pure risk from speculative risk? A. Pure risk involves potential for profit or loss. Speculative risk involves only possibility of loss. B. Pure risk involves only the possibility of loss or no loss, while speculative risk offers a chance of loss, gain, or no change. C. Speculative risk arises from unpredictable catastrophic events. Pure risk arises from everyday hazards. D. Speculative risk is legally insurable. Pure risk is not typically insurable. The correct answer is B. This option is correct because pure risk involves only the chance of loss or no loss, whereas speculative risk includes potential gain. Reason A is not correct. It reverses the defining attributes of each risk type. Reason C is not correct. This misattributes the distinction to hazard predictability rather than outcome possibilities. Reason D is not correct. It incorrectly asserts insurability rather than outcome uncertainty as the distinguishing factor. Question 15. Which of the following is an example of risk avoidance? A. Purchasing liability insurance against potential lawsuits. B. Implementing stricter safety protocols to reduce frequency of accidents. C. Closing a manufacturing plant to eliminate exposure to chemical spills. D. Transferring risk by outsourcing delivery services to a third party. The correct answer is C. This option is correct because risk avoidance entails eliminating exposure by discontinuing the risk-causing activity. Reason A is not correct. Purchasing insurance represents risk transfer, not avoidance. Reason B is not correct. Implementing safety protocols reduces risk frequency but does not eliminate exposure. Reason D is not correct. Outsourcing shifts risk rather than avoiding it entirely. Question 16. Hope Construction Co. self-insures its general liability risks under an unfunded retention program, agreeing to cover losses up to $150,000 per claim from current operating funds and ceding any excess to its insurer. Which of the following is most likely a consequence of this risk financing approach? A. Periodic contributions to a reserve fund. B. Reduced administrative burden due to insurer handling all claims. C. Increased internal claims processing costs for qualifying losses. D. Lower loss costs through transferring all claim obligations to the insurer. The correct answer is C. Under an unfunded retention program, the firm pays covered losses up to the retention limit from operating funds and handles those claims internally, leading to increased administrative expenses. Reason A is not correct. Periodic reserve contributions occur with funded self-insurance programs, not unfunded retention. Reason B is not correct. The insurer only manages losses above the retention limit. Retained claims increase internal workload. Reason D is not correct. Only losses exceeding the retention limit are transferred. Retained amounts remain with the firm. Question 17. Which of the following exemplifies an absolute acceptance under the mirror image rule, thereby forming a binding contract between the insurer and the applicant? A. Issuing the insurance policy on the exact terms requested in the application. B. Providing a conditional receipt, pending completion of underwriting review. C. Requesting additional applicant information prior to issuing coverage. D. Issuing a policy with modified coverage limits and adjusted premium. The correct answer is A. The correct answer is issuing the policy on the exact terms of the application under the mirror image rule, since absolute acceptance occurs when the insurer adopts the offer without modification, thereby creating a binding contract. Conditional receipts or any modifications constitute no acceptance or a counteroffer. Reason B is not correct. A conditional receipt is an interim acknowledgement of payment, but does not constitute absolute acceptance as terms have not been finalized under the mirror image rule. Reason C is not correct. Requesting more information alters the timing and constitutes a counteroffer or inquiry rather than acceptance. Reason D is not correct. Modifying coverage terms creates a counteroffer rather than absolute acceptance, so no binding contract is formed. Question 18. A Vermont business owner secures a binding receipt over the phone and then submits a completed insurance application, along with a $500 advance premium to the insurer. Coverage is effective upon binding. When the formal policy is later issued, which of the following constitutes the insured's consideration under the contract? A. The signed application containing representations of risk. B. Payment of the $500 advance premium. C. The producer's promise to procure coverage. D. The insurer's obligation to indemnify against covered losses. The correct answer is B. The insured's consideration is the payment of the premium. The insurer's promise to pay covered losses is its own consideration. Reason A is not correct. Submission of the application is a precondition for underwriting, but is not the value exchanged in the contract. Reason C is not correct. The producer acts as an agent, not as a party providing consideration under the contract. Reason D is not correct. That obligation represents the insurer's consideration, not the insured's. Question 19. After sustaining a head injury, an individual under legal guardianship in Vermont signs a homeowner's insurance application and remits the premium. Which statement best describes the effect of the contract, given the competency of the parties? A. Only the insurer must have legal capacity. The contract remains fully enforceable. B. Only the insured must be competent, otherwise the contract is void. C. Both the insurer and the insured must have legal capacity for enforceability. D. Competency requirements do not apply if a guardian consents on behalf of the insured. The correct answer is C. Both parties must have legal capacity for the contract to be valid. Lack of insured capacity renders the contract voidable by the incompetent party. Reason A is not correct. Insurer capacity alone is insufficient. Both parties must be competent. Reason B is not correct. Competency of the insured alone is not enough. The insurer must also have capacity. Reason D is not correct. Guardian consent satisfies insured capacity but does not remove the insurer's competency requirement. Question 20. Which element of negligence involves establishing a legally recognizable relationship obligating one party to conform to a standard of conduct? A. Link between the defendant's conduct and the injury. B. Failure to meet the required standard of care. C. Requirement to compensate the plaintiff for harm suffered. D. Legal obligation owed by the defendant to the plaintiff. The correct answer is D. The correct answer is the legal obligation owed by the defendant to the plaintiff, which defines the duty element in negligence. Reason A is not correct. This describes causation, which links breach to injury rather than establishing an obligation. Reason B is not correct. This describes breach, the failure to meet the duty, not the duty itself. Reason C is not correct. This describes damages, the compensation element, not the duty element. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below. We read them all. Find full practice exam books in the description or at ExamPrep.School.